Good afternoon, everybody. My name's Andy Spencer. I work for a firm called Accordance. We're international VAT compliance and consulting specialists. And what we'd like to talk to you this afternoon about is e-commerce in Europe and how that applies from a VAT and a customs duty perspective. So this afternoon we're going to talk about how VAT applies to e-commerce generally, both from a B2B and a B2C perspective. When you have to register for VAT in other countries, when you do register, what rate of VAT you have to charge, what sort of compliance obligations you've got, and then finally, what customs and duty implications there are. So it does tie in to some extent with the last session. So if we start with the basics, so if we look initially at a B2B transaction, if you're a business in one member state and you're selling goods to a business in another member state, it's relatively straightforward. That's a local sale, you charge local VAT. So if that's all you do, you only have to be registered in the country in which you're established and you just account for VAT in that country. The situation becomes a bit more complicated when you start to sell goods to another country. So initially, if we look at the EU, so the EU is now made up of 28 member states, so lots of businesses will be selling cross-border. If you sell to a business in another member state, the place of supply for VAT purposes, which determines where the VAT is due, is where the transport starts. So if it starts in the UK, the place of supply is the UK. Zero-rated supply because the goods are moving cross-border, and then the customer accounts for the VAT in their own country. They do it by a concept called acquisition tax. So again, it's relatively straightforward. All of the obligations are going to be in your own member state. So if you're a UK business selling cross-border, it's relatively straightforward. You need to meet some invoicing requirements. You need to meet some reporting requirements, such as EC sales list and Interstat, but it's relatively straightforward and the compliance burden isn't too significant. But that changes if you get involved in B2C sales. Now, B2C sales, the place of supply rules are the same, so it's where the transport starts. If the consumer's in the same member state as you, it's a local sale, so it's local VAT. So that's exactly the same as if it's a B2B transaction. But that changes. It can change when you've got a sale to a consumer in another member state. Now, the principle of VAT around the EU is that VAT should be due. The question is where, and that's what we're going to talk about this afternoon. So if you're involved in B2C transactions and you're selling cross-border, what obligations can arise in other countries, because it's important you get those right. So as we've said, where the goods are delivered in the UK, suppliers liable to UK VAT. So if you're already registered as a business, you don't have any additional obligations. You just have to know what rate of VAT to apply. Now, the way that VAT works in the UK is that there's a number of zero and reduced rates which can apply to goods. For fashion, for clothing, it's predominantly in relation to children's clothing. If the goods that you're selling don't fall with any of these schedules, you then default to the standard rate. Standard rate at the moment in the UK is 20%, so you account for 20% on your sales. So that's relatively straightforward. So if you're just involved in the UK, your obligations are relatively minor. But once you get selling to countries outside the UK, that's when the complications arise. So the way the system works is that when you first start selling to customers in other member states, initially you still continue to charge UK VAT. Place of supply is the UK, because that's where the transport starts. So it's relatively straightforward when you first start trading. But because of the variety of VAT rates around the EU, there's a concept called distance selling thresholds. And what these do is to ensure that there's not a distortion of competition because of the VAT rates. So, for example, the lowest VAT rate in the moment in the EU is Luxembourg with 15%, but the standard rate of VAT in Denmark is 25%. So there's a 10% difference between the VAT rates in the two countries. So if you didn't have a mechanism such as distance selling, what could happen is all of the private individuals in Denmark could go online, buy from Luxembourg, and pay VAT at 15%, because that's where the delivery of their goods is going to start. Now, that would obviously deprive the Danish tax authorities of VAT. VAT is a really important way of raising revenue for governments and tax authorities around the EU. So there needs to be a mechanism to make sure that there isn't this distortion of competition. And the way that that works is essentially once you exceed a distance selling threshold, you have to register in the member state of delivery of the goods. Now, the important thing to bear in mind is this distance selling concept only applies in relation to the EU. If you sell outside of the EU, it can be zero rated as an export, but there can be complications in the country of import. So you need to think about what the customer experience is going to be like, what are the implications going to be for your customer, even though you're not going to have any obligations yourselves in the UK. So if we look at that briefly, so treatment of sales, this is B2C, if you're below the threshold, so say you're a UK supplier and you're selling to a French customer. So initially, you're below the threshold, so that sale is liable to UK VAT. So you would look at what the item is you're selling. If it's zero rated, you don't have to charge VAT. If it's standard rated, you'd account for that at 20%. So you'd follow the UK rules in relation to the VAT rate. You'd follow the UK rules in relation to invoicing requirements. You may have interest obligations in the UK. Interest is the mechanism which records trade statistics on sales between EU member states. So again, it's relatively straightforward. Once you go above the threshold, so you've got exactly the same transaction, but you've made sales above the distance selling threshold for France, it then becomes liable to French VAT. So you then need to follow the French rules in relation to the VAT rate. You then need to follow the French rules in relation to invoicing requirements. You might still have those interest obligations in the UK that you had before, but you might also have additional reporting requirements in France as well. So you can see, as soon as you've exceeded this threshold, the position changes quite significantly, and so you need to start accounting for VAT in a different country. So the consequences of breaching the threshold, you have to register for local VAT, so you need to find a way to be able to do that. You need to charge local VAT at the appropriate rate, so you need to know what the rates are. You need to know what reduced rates there are, and my colleague Laurent will talk about that shortly. You're also going to have to complete local VAT returns. So you charge the VAT, you need a mechanism to be able to pay it to the tax authorities. As I've mentioned, you may also need to complete Introstat declarations. Unfortunately, Introstat, the thresholds are considerably higher, so quite frequently you can be registered for VAT in the other country but not having to complete Introstat declarations. And one thing to think about as well is the variety of VAT rates that occur around the EU. And we'll talk about that a little bit more in a moment, because that can have an impact on the margins that you're achieving. So when do I have to register? So we've realised now that we do have to register if we exceed these thresholds. The thresholds, essentially, they're a simplification measure in order to avoid registration for low levels of sales. So the tax authorities in the other countries don't want every business that makes a single sale to their country to have to register, because the cost of having to administer that registration is not going to be sufficient to, the VAT is not going to be worthwhile. So each member state's got its own threshold. They can essentially choose between 35,000 and 100,000. Thresholds can occasionally change. The last threshold that changed was Austria, which reduced it from 100 to 35. So they made the decision they want businesses selling into Austria to start having to pay Austrian VAT at an earlier stage. So essentially the countries are deciding, do they want the administrative burden of having to get businesses registering at 35,000, or do they want to wait until they've actually got significant levels of sales? The other thing to bear in mind is the thresholds can be in local currency. So for the Eurozone, it's relatively straightforward. Countries outside the Eurozone, they're going to have their own thresholds in their own currency. So we just quickly look at 5 of the big countries. So you can see the UK's got 70,000. France and Germany have chosen 100,000, so they've decided that they don't want businesses that are making relatively low levels of sales to have to register. But Italy and Spain, like a lot of other countries, have got a 35,000 euro threshold. So that's the relatively low level of sales which can trigger a liability for you to be registered in another country. So a few things about the thresholds. They apply on a calendar year basis, so 1st of Jan to 31st of December. If you don't exceed in the calendar year, you effectively start again at nil the following year. You then need to monitor your thresholds. You need to find a way of being able to determine what your sales are. Many companies that we see when they first start up, they don't recognise that they need to be able to record sales made to other countries. So they'll just be happy that they're making sales without realising that they need to monitor where those sales are being made to. Once you've exceeded the threshold, there's an immediate obligation to register. So you need to make sure that you register at the right time. If you don't register at the right time, you can incur penalties and interest. Tax authorities in other countries can also be and treat breaches of registration. They can be a lot more seriously taken than the UK will. The UK, I know you probably don't realise it, but a lot of the times the UK can be quite relaxed in relation to penalties. You also need to recognise that it's the destination of the goods which matters, not where your customer's based. So if you've got a sale to a UK person but the delivery is to France, that's a distant sale to France, so that's a sale that counts towards the French threshold. And finally, you need to recognise that if you hold stock locally, these thresholds don't apply, because what you're doing then is you're making a local sale. You're not making a distant sale, which is what happens where the goods are delivered from one member state to another. So if thresholds, normally there's no threshold for businesses that are selling goods locally. So if you hold stock in another country and sell B2C, that normally means you're going to have to register straight away. So that's a little introduction to how VAT applies. So I'm going to pass you to my colleague Laurent, who's going to talk about what VAT rate applies when you do register.
Thanks, Andy. So we've established that if you're selling into other EU countries, you may have to register for VAT. So what happens when you start selling goods into those countries? You can have to start charging a different rate of VAT. And basically, the rule is wherever the goods are being delivered to, the destination of the goods is the VAT rate applicable to that particular good that you're selling. The rates around the EU can vary substantially. As Andy mentioned, the lowest rate of VAT at the moment is 15% in Luxembourg. It's due to change to 17% sometime next year. And the highest rate is 27% in Hungary at the moment. But there's no maximum rate that's actually set within the legislation, so it could be even higher than 27% theoretically. And the UK rate is actually one of the lower rates at the moment. It's 20%. The average rate in the EU is about 21.5%. So at the moment, the UK is actually not too bad in terms of VAT rates. Okay, and here's just a summary of the 5 main countries and their VAT rates. As you can see there, France changed from 19.6% to 20% at the beginning of this year. So the rates do change from time to time, so it's just important to keep track of what rates are changing, which countries, and at what time they change as well. In addition to the standard rates of VAT, they also have reduced and zero rates of VAT. The UK has a large number of zero rates and reduced rates applicable. For children's clothing, for example, there's zero rate applicable in the UK. It's not always replicated across the EU. I think the only other country that applies a zero rate of VAT to children's clothing is Ireland, and I think Luxembourg has a reduced rate of 3%. So if you are selling children's clothing into other countries, just be warned that you probably would have to start charging the standard rate of VAT in that country. Other member states have lots of reduced rates. For example, France, I think, has several reduced rates, 10%, 5.5%, and a super reduced rate of 2.1%. So again, working out which rates apply to which products you're selling can be quite complicated, and it's quite important you establish and you understand what rate is applicable to the items that you're selling to make sure you're accounting for VAT correctly. And also, if you think about in the UK, if you're charging 0% or a reduced rate or even 20%, and then you suddenly you're selling into maybe Hungary or one of the Scandinavian countries which has a high rate of VAT, 25%, that's going to have an impact on your profit, basically, because you'll be accounting for a higher rate of VAT than you would be in the UK. So you need to decide whether you're going to increase your price to reflect the change in VAT rate, or if you want to have maybe a composite rate where you would have a particular rate and just take a hit in some countries where there's a higher rate, or maybe make a profit in some other countries where you're selling and there's a lower rate of VAT. So here again, just an example of 5 key countries. As mentioned, the UK has 5% and 0 rate on children's clothing. There are lots of other products as well which could be subject to 0% as well, but some countries don't have many reduced rates. Germany and France and Italy don't have any zero rates either. Okay, so now we've worked out that you need to register and start charging local VAT. What else do you need to consider in those countries? When you are selling into a local country, the tax authorities are going to be interested in knowing about your business and understanding what VAT you're declaring to them. At the moment, distant sellers are really quite high profile because it's a win-win situation for the tax authorities. They are really keen to make sure that any e-commerce retailers are registering within time and paying over the right amount of VAT, because it's just a money in the bank for them. They'll get their VAT and they'll collect it. We've actually seen some tax authorities to set up specialist teams that will look at businesses trading online, whether it's through a platform or via their own website. They've set up actually their own teams that will investigate businesses and make sure that they actually account for VAT when they should be in their local country. Actually, there's a couple of countries that spring to mind. Sweden is one of them. Germany is another country which has actually gone as far as contacting a UK business and saying, look, you should be registered in Germany. Why haven't you registered yet? So that's just something to be aware of. This really means that you need to actively manage your selling volumes into various countries. As Andy mentioned, it's on a calendar basis, so you'll need to make sure that if you are close to breaching within a calendar year, you take the appropriate steps to notify and register in that country, and then charge VAT at the applicable VAT rate. So once you're registered, you'll have ongoing compliance obligations, such as VAT return filing. In the UK, normally you file quarterly, sometimes monthly. In every other EU member state, it depends. Generally, it's monthly, but it can be bi-monthly, it can be quarterly again, it can be 6 monthly, or it can be annually. So it's really important to understand what your compliance obligations would be. Some countries have compulsory electronic filing, so the only way you'd be able to submit and comply with the VAT rules would be electronically. And sometimes you might need a local address to do that, or local representation. So again, these are additional considerations that you'll have in order to comply with the VAT legislation in that country. And again, when you start to submit VAT returns and other declarations, you need to consider that some countries will only accept it in their local language. So do you have that sufficient resource in-house to be able to deal with that, or will you have to maybe get help from outside? One other thing in terms of compliance is that in the UK, if you're selling online, you might not issue a formal VAT invoice. It's only required really if the customer requests one. In most other EU countries, there is a requirement to issue invoices, valid VAT invoices, so it lists out the VAT, the net amount, the gross amounts, and the local currency, et cetera, et cetera. And in most other EU countries, there is a requirement to formally issue this VAT invoice. So as soon as you start sending goods into that country, that's another thing to remember, is that you have to start sending these invoices along with the goods. It can be done electronically as well in some instances. So here's just a summary of, again, 5 key countries where the reporting frequency differs. As mentioned, the UK is quarterly. In Italy, it's done on an annual basis, but you have to make monthly or quarterly payments. In Germany, it's normally monthly unless your turnover is particularly low. So in addition to VAT, there's a couple of other things. Obviously, there's countries like Norway and Switzerland within the EEA, but not within the VAT regime of the EU. And as Andy mentioned, when you sell goods to those countries, these won't be part of the EU, so they don't actually fall under these distance selling rules. So they will still be treated as an export from the UK, not subject to UK VAT. But you need to be aware that you have to maintain and retain evidence that those goods have physically left the country in order not to have to charge UK VAT. Now the goods have left the UK. If they're going to maybe Norway or Switzerland, there's also considerations that, in getting those goods into that local country, and who's going to be responsible for paying any VAT or any taxes to get those goods in. Often it's the customer that's responsible for doing this. So when they buy something online, in the shopping basket will say it'll be X amount, but actually when it arrives at the door, they're going to have to pay additional duties or taxes. This can be sometimes an issue that might complicate things. They might not be expecting to pay this, so on your website, it's probably good to have some sort of narrative which says the customer is responsible for paying any additional taxes or import taxes. Another consideration is for duty. If duty is applicable when you're sending goods to another non-EU country, but within the EEA, duty isn't recoverable. So there's some simplifications that might be available, maybe some things such as bonded warehousing, things which could help relieve the actual cost of duty. Okay, so told you quite a lot about VAT. It's quite a lot to take in, but some key points to remember. So when you're selling to private individuals in other countries, it may lead to additional VAT registration, so really need to monitor your yearly sales. Again, it's on a calendar year basis, so if you don't breach the particular distance selling threshold in a calendar year, it starts from 0 again the next year, so that's really important to consider. If you do breach, but you don't notify the tax authorities in time, and believe me, it happens quite a lot, sometimes businesses keep on trading for several years without even realizing they've got a requirement to register. Tax authorities will look to impose penalties and fines and interest, as well as any VAT that's due as well. So it's really important to monitor those levels of sales. Again, check the VAT rates in the EU countries. Mentioned that the UK has lots of zero rates available for some goods. Other countries could be a lower rate of VAT applicable to your goods, so it might actually be beneficial registering before you even breach a distance selling threshold, because that way you can actually make a profit of the VAT difference. For example, if you've got particular high levels of sales into Luxembourg, where it's 5% lower than the UK rate at the moment, then it might be advantageous registering there in advance. Again, there's compliance requirements. Make sure you get your invoicing right. Make sure you get your returns right. And if you're in any doubt at all, always advise to get some help.